Right. Now to the stress test. The Federal Reserve announced that all major U.S. banks could endure a severe recession while continuing to lend to consumers and corporations. Joining us now, Ebrahim Poonawala, BofA Securities Senior North American Banks Analyst. Ebrahim, great to have you with us. All 31 passed, but obviously there are differences in how they passed, how well they passed. And I think people were really keyed into that yesterday when the results were released. Goldman and Wells did not look as good. Can you walk us through why and what the implications are?
Sure. So first, thanks a lot for having me. And we said this going into this, the stress tests are inherently opaque and create surprise. Last year, there was a little bit of a positive surprise across the board. As you pointed out, Goldman, Wells did not look as well. And you saw their what's called the stress capital buffer that drives the minimum requirements go up year over year. I think you will see, just from a very near-term standpoint, those stocks come under pressure this morning. Is the thesis changing? No. But I think, again, it takes you back to how intertwined all things regulations and the banks are. And it impacts in terms of how equity investors think about valuing the group and thinking about the ROE outlook for the sector.
Does it underscore Wells's, for instance, higher exposure to consumer? And maybe that could be a concern for investors if you are a believer that the consumer is under pressure.
So I think the conversation that Joe and you were having earlier, it's worth reminding the hypothetical scenario.
Right.
Unemployment rate going to 10%, equity markets down 55.
It's drastic.
It is drastic, right? Yes. So I think it needs to be put in context of how it's hypothetical, it's opaque. But you're right. I think as we think about fundamentally, if the economy has a hard landing, what do you worry about? You worry about business loans. You worry about consumer and credit card loans. So it's a good reminder of where the loss rates could come if the economy doesn't quite have the soft landing that many are hoping for.
Do you think any of the banks will announce increased payouts as a result of this, or are they going to hold? It would be prudent for the banks to hold off until Basel III is finalized, since there's some rumblings that it could be less onerous.
So, yes, and I think there's uncertainty whether we receive any clarity before the elections or not on Basel III and which route the regulators take. But we do think the one name that sticks out in terms of the big bank, Citigroup, they saw some relief. And I think that's a management team that is keen on increasing sort of buybacks. I think investors would like to see that. We expect Citi to react positively to last night's results.
How about JP Morgan? JP Morgan's already had a large payout, but Jamie Dimon has said, our capital cup runneth over. I mean, should we expect more from JPM?
So I think if you think about JPM, they have, give or take, about $50 billion of excess capital, even after the slight increase last night. And it's less about the minimum requirements, and it's more about their CEO, Jamie Dimon's views around the macro. Things could get worse, and having some dry powder for those scenarios relative to the stock trading north of 2 times tangible book, all-time highs. So I think it's a function of just management's view around the outlook and their own valuation, as opposed to having the wherewithal to buy back stock.
As time goes on, are you less and less worried about a hard landing in commercial real estate? Have the fears sort of abated, or the larger banks don't have as much exposure, but the regionals still do?
It's a great question. And again, to us, there's a lot of headlines around CRE over the last year. There's CRE office, which is a unique sort of stress point in and of itself. And there's all other things CRE. I worry about all other things in CRE if we get into a stagflation. Employment rolls over, but inflation is sticky. Then you get the worst of folks can't afford rents, but cost of borrowing is still high for these landlords. So you could get there. And that's what, as in every month we move without the Fed having to cut rates, you worry about that scenario, less about the back half of the year, but into 2025.
So it is an issue still.
So it's an issue, and I think that's why you see regional banks react negatively to higher for longer rates, because they are economically sensitive, and the stagflation scenario could create some pain points next year.
Ebrahim, thanks so much for coming by.